Welcome to Street Talk, S&P Global Market Intelligence podcast that offers listeners a deep dive into issues facing financial institutions and the investment community.
I'm Nathan Stovall, and on this episode, we're looking back at the banking industry in the 12 months since the liquidity crunch of 2023, and we're talking about what has changed, how banks have changed their positioning, what their balance sheets look like, and importantly, how do regulators and investors view the sector a year later now that the dust has settled? Coming back on the show to offer his view on the lasting impacts and his view of the sector, that's the part we're perhaps most interested in, is KBW CEO Tom Michaud. Tom, thanks so much for coming back.
Nathan, great to be with you, and I look forward to today's discussion.
So, Tom, let's look back the past year. What do you see are the big lasting impacts, maybe lessons learned? How do you look at banks today from a positioning standpoint, and how does it compare from a year ago?
So a couple of things. One is, while three medium-sized to larger banks did fail, and they failed rather spectacularly and unfortunately, I think it's two things. It's one is understanding what happened there, number one. And then number two, don't forget 4,700 banks did fail and did manage their way through that period. But sometimes I feel as if the ones that got off base become the center of all the conversation. You kind of miss where the majority of the action really is. With regards to the three banks that failed and the lessons learned, I had a chance to testify in front of Congress for the reasons on the failure and policy recommendations to do about it. In preparation for that, I had a chance to read through all the FDIC failure follow-up reports, which I thought were really well written. They had a lot of information in there that I didn't know previously. I started my career as a bank credit analyst for a division we had called Bank Watch. So really, being a credit analyst is where I started and learned the analysis business in my career here at KBW. And I looked at it, and it looked to me like many of the golden rules of bank credit analysis were violated. Meaning, when I saw that Silicon Valley Bank had $13 billion in their top 10 deposit relationships, with almost all of that uninsured, really startled. I mean, that was staggering to see. So that was really one. Number two is concentration is a higher risk thing to do. And when you look at the concentration of deposits, concentration of industry segment, concentration of individual relationships that rolled up to one venture capital firm, when you see all that, you see that it just really was not a fully distributed client base, and that there really could be some pro-cyclical nature as to what could happen. And the other takeaway, there were plenty of early warning signs that were not adhered to. At Silicon Valley, I think it was 39 MRAs that hadn't been addressed, didn't have a chief risk officer for almost a year. At First Republic, there's a story in there about how their dashboard for risk sensitivity started to blink red in the second quarter of 2022. And the board's reaction to that was, management's going to monitor. And then it happened again in the third quarter, and the answer was, management's going to monitor. Other takeaways of all this is that the idea, too, that held-to-maturity accounting would be the safe harbor during the entire period was a key assumption that turned out to be unfortunate. I believe the run at Silicon Valley Bank started because the depositors got more nervous than the rating agencies and the regulators, which was interesting, and that was the risk.
Right.
And the risk there was you don't have bank lines at branches, really, even though there were some. This was all electronic, and it was all overnight. So this was just different. But these were some of the guardrails of what I'm aware of, which are just good, sound banking practices that kind of got off base. And by the way, the policy response has been more capital, okay? The reality is these banks were well capitalized. The shocker is First Republic Bank was upgraded to a 1 rating for liquidity not right before, but the last rating change was to a 1 before they failed. tells you that the old regime of analyzing these companies has changed, and that supervision needs to adapt to the new world. And just coming with a rules-based approach alone is not the answer. And raising all the capital ratios and gold plating it to the degree that it's been done, I think is overreach. And if you want to know what overreach may look like, we have an example. Go to the mortgage market, where going into the global financial crisis, banks generally made 90% of the mortgages in America, residential. Today, it's 20% and declining. It's not that banks don't want to make mortgages. It's not that they don't realize that a home mortgage is a central part of a typical retail customer's financial life. It's that there are other reasons why they're not in that business like they used to be. And I believe it's because of the capital rules changes for mortgage servicing rights, which is where really a lot of the economic value lives. It's for the fact that if you're a bank, you have multiple regulators in the business that non-banks don't have. That's a competitive advantage for non-banks. CFPB does regulate everybody. But those are some of the examples of what happens over a decade or more when regulation changes. So don't think that these rules today won't have an implication on the industry for the next decade.
Yeah, and I want to pick up on that too. And I heard you speak at Acquire Be Acquired, and you almost made the same point. Yeah, I heard you going there of what kind of financial services industry do we want? I feel like you were just kind of saying, I remember you saying that's a great point, that they aren't necessarily thinking about it holistically, because that is what is happening here, right? You've got all different kinds of industries coming. And I love the slide you had about the changes in market share, the mortgage market share that you just alluded to as well. I mean, that really is striking when you see those two things side by side over a 15-year period.
And a part of the more recent proposal is that the banking regulators want to give an operating capital charge for non-balance sheet businesses. When I see that, it reminds me that during the global financial crisis, the leading American investment banks were encouraged one night to become banks. Now they're going to come with a tremendous amount of capital charges on those very banks, and the outcome could be they need to get rid of their investment banks. So we'll go right back to where we were last time, and we'll have done a complete circle with government regulation. So which one is it? My view would be we're at a stage where we really need to focus on what's the regulation that we ought to have across the entire financial services spectrum, and not just pick individual slices of it, whether it's banks, insurance companies, or any. You've got multiple different regulators headed in different directions. Wouldn't be bad if we had a coordinated approach across the whole sector. Otherwise, the industry is going to look a lot different in 10 and 20 years from now, in my opinion. Let me also talk about one other point, which is I do believe the AOCI and the mark-to-market issue of it being exempt for regulatory capital ratios should be changed from what it was before last spring, meaning mark-to-market probably should be pushed down into the banking industry more, because I think if it had been, you probably wouldn't have had the duration in some of those assets that you had. Well, I think that actually was a smart fix, and I think that's worthwhile doing. The capital ratios, whether it's Basel III or how heavy crossing $100 billion is, I will highlight to you that some of the public statements by bank CEOs that the annual cost of being a $100 billion bank could be $125 million. If that's the case, I can guarantee you there'll be no $101 billion banks in America. They're either going to not cross $100 billion, or they're going to hurl themselves across $100 billion to pay for the $125 million.
And that's what 15 bips off their ROA right there, basically. I mean, that's a significant marker.
Our research has been tracking these stocks and factoring in the cost and normalizing an earnings model. And you can see there's 100 to 200 basis points dip in return on capital, and investors are going to factor that into stock prices, and it's already started. So these actions have, if the goal is to do that, I'd love to have an overarching policy statement for why it was done. Is it to remove risk from the banking system, which it might be, or is it, do we want fewer banks, or we want more activity in non-banks because we think it's getting it away from deposits and we'll have less depositor risk? Whatever it is, I think that the policymakers should cite what the ultimate goal is.
Two things I want to pick up on that you were talking about that were really interesting from the failures of concentration. That's an old idea. It's been around a long time. And having triggers on your risk policy being hit and not enforcing them. The reason why I come back to them is both are things that are pretty old school in banking. And was that kind of the point you're making? We don't need to necessarily rethink this.
100%. And then I'll even throw in, there's another dimension I realized I didn't even say, which is growth. Silicon Valley Bank grew 85% in a year organically. That never happens. If you think about it, banks kind of grow as fast as GDP plus something if they're taking market share. That was unusual. And I think the new reminder here is banks typically don't grow that fast. And if they do, there should be further examination about what's happening.
Mm-hmm, mm-hmm. Right. If you're outgrowing your market, you're taking risks somehow. I remember somebody told me that a long time ago when I first started following this business.
But it's not like, let's say your market's growing 4 and you grew 6. That's not the issue. The issue is, your market's growing a few percentage points, but you grow 85%. That's a little bit.
Right. Well, you spoke to this earlier as well, the impact of regulation, the impact on return, and how it can negatively impact valuation, and you're already seeing it, and you've highlighted, and the firm's research has highlighted, it's already negatively impacting valuations. What difference are you seeing there? Are you seeing lines at the $100 billion mark? Are you seeing it at different places? Because coming out of the GFC, you wanted to be kind of that 5-10 range, and now I feel like it's totally flipped.
We wrote a report that I think is going to go down as one of our seminal research reports. We call it Chutes and Ladders. You remember that childhood game we all played, which is, you kind of climb up the ladder till you hit the chute, you go backwards a little bit. Well, that's what happens, we think, to the profitability in the banking industry as you approach a regulatory threshold. It could happen at 10 billion. It could happen at 100 billion. It can happen at 250 as you keep hitting these major thresholds. But one of the bigger chutes now is at 100 billion. And so that's going to have implications on what the industry looks like, because the management teams and the boards of these companies have to factor that into their planning. And again, it just adds a different degree of impact on what the industry looks like. And I think it ultimately could have an impact on availability of credit, which is what I think policymakers should want for small business. Because I think the banking industry is breaking into 3 segments. You've got the top 25, which is really, the top 4 dominate the top 25. But the top 25, they've got 2/3 of the deposits in America. You've got 10 billion and under, where 97% of the banks are, and 97% of any number is almost all of it. And then you've got the middle part, these mid-sized banks, where there are a little bit more than 100. I think those mid-sized banks are some of the gems of our economy that not every nation has. And they tend to be more small business focused. And they're the ones who could really benefit, I believe, from FDIC insurance. Because what we saw in the last crisis is that small businesses got worried fast, and they started to try to move the bulge bracket top 25 universal banks. We don't want to be in a position where America picks their bank based on its asset size every time there's a crisis. That would be bad. And that's the reason why the FDIC was created to begin with. Interestingly, you can go to the FDIC website. Last time I was there, they had FDR's speech or part of it. You can listen to him tell you why you need an FDIC. So we need it. We just need to modernize it for modern times. And I think the way to do that is by raising the limit for payroll accounts, which are transaction accounts. And if they need to be non-interest bearing to try to offset the moral hazard argument, so be it. But that's what we should do. Because, by the way, don't think big is always safer. Because the biggest bank failure of the last year is Credit Suisse, which it didn't technically fail. They did decide to sell to a 100-year competitor across the street over a weekend with government intervention, I assume. They needed a partner, and they were a global SIFI. They're one of the biggest banks in the world, yet they needed a solution. So the point is, big doesn't mean better, but big might mean too big to fail. And that has to be neutralized. And the FDIC, to their credit, wrote a very good report about the options for policymakers. And there's one called the targeted approach. I would be all in on that and raise that to $10 million. You don't take a lot of risk to do that. And it could even be non-interest bearing, which would offset the moral hazard argument. The other thing that should happen is banks should be allowed to purchase additional insurance for their customers, which they're already doing via these electronic platforms. So that risk is already in the system, but you probably don't need the intermediary. You should be able to have the FDIC fund, have it available if someone wants to purchase it. So if you're a smaller bank and you want to bring on board a commercial customer who wants that security, you can sell it to them you can have them embedded into the pricing.
We had it with the TAG program, right? We had this program coming out of the financial crisis. We utilized it. It went away because it was temporary, but there's a model for it, right?
Yeah. And my view is that that's a small business thing. Because half of America's jobs are in small businesses. And remember, when the Triple P program came out during the pandemic, and the government wanted relief in small businesses' hands fast, 55% of that relief went through regional and community banks. They don't have 55% of the deposits in America, but they're the ones who are connected with these small businesses. And it's a lot of it is these mid-sized banks, and you need them there to serve small business to grow the economy. And that's why, that to me, that's how the dominoes stack up for why it's a good decision. And I don't think it's a dangerous decision. No one's saying insure all the deposits. If you combine it with strong supervision, I don't think the fund is taking much more risk than it is now.
Absolutely. And you're not the only one making that case, and I think it's very logical. What you spend a lot of time, aside from the regulatory side, you spend a lot of time talking with investors. We saw the group obviously rally off of the lows in the summer of 23, and then we've kind of come back to a little bit of a holding pattern here. CRE being the thing we probably hear too much about without enough nuance there. What is on investors' minds? Are they concerned? Do you think there's not enough nuance in some of those conversations? What's your view?
Nathan, I got to tell you, I think there's a giant paintbrush that paints the whole industry at the same time. It's incredible. The other day when New York Communities was halted, at the time they were going to announce the recap, I was watching the BKX and the KRX. The KRX, the Keefe Regional Bank Index, was dropping. And it's because when there's a problem in the industry, all banks seem to be put in the same bucket. Whereas if you really peel it back, we researched over 200 of them. They're not all the same. I think number one is that's opportunity when that happens because you can buy shares that are being impacted that don't have the same risk. Number one. But number two is it doesn't affect the investor psychology, which is until we probably feel like we get more of an all clear signal for commercial real estate, it's hard to think that the group's going to have a really big rally. And the danger, I think, from commercial real estate is not that it's an industry stability issue. It's an earnings issue. And we've got in our industry models for this year 26 basis points of provision. That probably still is below average for a cycle. So if we do start to get commercial real estate losses, even if it's not going to impact book value or profitability. These banks can still be profitable, but your earnings estimate could come at risk. So I think it's more of an earnings estimate confidence issue while we've got this commercial real estate issue out there. But then we can unpack commercial real estate. It's a huge category, big asset class. There are slivers where the risk is greatest. It's typically large office building, urban centers, typically coastal. If you want to look at what that looks like, Wells Fargo produces that information in their earnings. They've got 10.5% reserve against that type of portfolio. The reality is losses in the global financial crisis in that category weren't 10.5%. So you'd like to think they've just built a fortress reserve. So that's one area of concern. The other areas are anything that's been rent controlled, and I could go into the dynamics if you wanted to go deeper about why rent controlled buildings have been under so much pressure. I think another issue is seasonality, meaning loans made in 2020 and 2021 when interest rates were zero are likely to adjust. And are those borrowers going to be ready for current market rates? And that's frankly in every asset class. And that's something we'll be talking about, and that could be a headwind for the economy. But again, bankers know this. They're out in front of it. They're restructuring. They're asking borrowers for more equity. So I think for all those reasons, it could be an earnings issue, but I don't think it's a big solvency issue for the industry. Then there are some banks that just don't have any exposure in that. I keep using the Montana banks. I think the Montana banks are good banks. They don't make a lot of San Francisco and New York City downtown large office buildings. They just don't do it. So when you see those, and then you look at dividend yields. One of our favorite stocks is Truist. You get a 5+% dividend yield. I believe the next time that dividend changes, it's going up, not down. And these are really good. And the bigger banks, I should give you another sliver here. The bigger banks have less commercial real estate. We do favor the bigger banks to the smaller banks at the moment because we think they have less earnings risk because they tend to have more liquidity and less commercial real estate, and they do have the benefit of scale at the moment. So if you were to look at our ratings, more of our favorite ideas are the largest banks.
And investors have gravitated towards there with that idea as well. And I happen to be, I've made the same case that you just made to a number of people, so I'm happy to hear that I'm in good company. That it is an earnings issue, not a safety and soundness issue. Well, in closing, you spoke to this some. What's the catalyst for the group and investors? I mean, I think some of it's just time. It feels like this is going to take a while because that's just sort of how this credit stuff plays out. It's not a 1-month event. What do you see? I mean, you obviously talked about some disconnect, broad brush, so there could be opportunities today. But what kind of gets people excited, do you think?
Well, the rally that we got off at the end of October was really around the Fed pivot. So the Fed pivot was the Fed's not going to keep raising rates, likely to cut rates. So the bond portfolios for banks and the pressure on credit is going to be less. And for those two reasons, you could take the worst case scenario off the table. So all we needed was the worst case scenario to not happen. That was the 35% move from the end of October to the end of the year. I think that was the rally you were alluding to earlier in our chat. I think what it's going to take is it's hard to because investors are nervous about credit, and the only way to prove it wrong is to report your earnings and not have a big credit problem. And remember, too, CECL has required the provisioning up front. So that's going to be a little different. We're all in a little bit of a new world with the accounting for reserves. My view is at some point a light will go off. It'll probably be where there's a macro opinion that the economy is not going to have a hard landing, that we're further beyond the COVID moment, and that the earnings estimates for banks are more rock solid. When you get the rock solid feeling in earnings estimates, I think that could be when they start to move. And for some of the biggest banks, too, investment banking as a business line has been really weak. And we've been recommending some of those stocks because we believe there's a turn that's likely to come. Every time in history, there's been a turn. And when it happens, it doesn't happen in a small manner. It tends to be quite robust. So investors have already started positioning themselves for that. So if you start to get revenue improvement because the margins get better, non-interest revenue gets better, credit's not falling off the table. That is these stocks, if the market believed all that, these stocks are at a discount and they're going to outperform. It's coming. I don't know when. Now, by the way, we may still get some accidents. There may still be individual banks that get offsides on something, just like New York Community just did. It won't be perfect for every bank, but I think the industry overall and the typical bank, that moment will come.
Well, terrific. Well, I think it's a great place for us to leave it. Tom, thank you so much.
Nathan, great to be with you.